Hello, everyone. Welcome back to our channel and welcome back to another episode of the Capital Insight series. Today, within the Fundamentals Through Noise series, we are going to be talking about the AIIPO supply mechanics and the allocator absorption. It's about the engineered distribution architecture behind the coming wave and what it means for the cross-asset positioning. We'll talk about SpaceX, OpenAI, and Anthropic together, implying almost $180 billion of new equity supply, more than the entire 2000 IPO haul in real terms, concentrated in just one sector, and that is AI. We'll also talk about the three rule changes: the Nasdaq fast entry, S&P inclusion shortening, staggered lockup design that have engineered a coordinated distribution mechanism. And we'll also look into the absorption question that matters more than the product comparison. Against a bond market stress, the funding source for 180 billion shapes the second-order risk out here. SpaceX is a telecom infrastructure trade with AI option. The pure play AI exposure sits with OpenAI and Anthropic, neither without compromise. Now, with this context, let's do a deep dive into what's really happening. Let's talk about the AI supply mechanics and the allocator absorption. Now, recently, we have seen so much coverage about the coming wave of mega IPOs as a contest amongst three founders of the same enterprise applications opportunity. However, if you look closely, that frame collapses the four-layer AI structure into a binary and treats the listing primarily as a stock-picking exercise. The more consequential story out here for the allocators is the upstream of which name wins, the scale of new equity supply hitting the market in a compressed window, and the mechanism by which that supply is being engineered to clear. Let's start with the setup out here. SpaceX is targeting a June listing at a reported valuation approaching $2 trillion with a deal size that could reach $75 billion. OpenAI has reportedly filed a confidential prospectus. Anthropic is fielding proposals that would value it as high as $900 billion. If each company prints at 5 cents float, the combined new equity issuance approaches $180 billion. For comparison, the entire 2000 IPO haul totaled $106 billion, approximately $200 billion in today's money, drawn across all the sectors and spread over 12 months. The 2026 wave concentrates a comparable figure in a single sector and a compressed window. Now, this is the supply side question that the product comparison frame obscures. Against a bond market still digesting the energy shocks and fiscal sustainability concerns, with US Treasury, Gulf, JGB, and Eurozone sovereign curves all under stress simultaneously, the absorption constraint becomes a dominant variable. The interesting question out here is not which of the three wins on product. It is where the marginal $180 billion of capital comes from and what must be sold to fund it. And this brings us to the engineered distribution. Now, what distinguishes this cycle from the prior IPO bonanza is the degree to which the post-listing distribution mechanism has been formally restructured. Three rule changes are converging in a way that materially alters the dynamics by which the insider supply meets the index demand. Nasdaq introduced a fast entry rule in May of 2026 that shortens the waiting period for the mega cap stocks to be included in Nasdaq 100 to just 15 trading days, down from as long as a year. S&P Dow Jones Indices has proposed a parallel chain shortening the S&P 500 inclusion to 6 months from 12, with implementation possible just before SpaceX lists. Issuers and the underwriters in parallel have been engineering staggered lockup structures that release insider supply ahead of the conventional 6-month mark. Cerebras has tranches unlocking in August, September, and October. SpaceX is pairing unlocks with quarterly earning trends and price triggers. Read together, these are not three independent developments, they are a coordinated distribution architecture. Passive flows, that is the pension funds, retirement accounts, and index trackers, become forced marginal buyers exactly during the window in which insiders are released to sell. The mechanism transfers wealth from public to private holders at scale, and it does so on a timetable that issuers and the underwriters increasingly choreograph. Now, for the allocators, this matters for two particular reasons. First, it changes where the demand actually comes from in the first 12 months. Less from the discretionary public conviction and more from the rules-based passive inflows that are insensitive to valuation. Secondly, it concentrates the post-inclusion period as a structural risk window. Once the forced passive demand has been absorbed, the marginal buyer must be a discretionary one at whatever clearing price emerges. Next, let's talk about the base rates. Now, mega IPO as a cohort have poor empirical record, and the cohort most relevant to SpaceX has the worst record of all. The reference series maintained by Jay Rater at the University of Florida covers 1,724 US IPOs from 2011 to 2024. The average first-day pop is 23%. Subsequent three-year performance lags the market by 25 percentage points. Narrowing to the 15 billion plus issuance cohort sharpens the picture even further. Of the 36 US companies that have listed at that size or above, only 9, that is 1 in 4, have beaten the S&P 500 from their first-day close. Just under half have generated positive absolute returns at all. The distribution is dominated by a small number of structural winners, for example, Alphabet and Palantir, and a long tail of structural losers, for example, Lyft, Lucent, Palm, etc. Now, the cohort that matters most for SpaceX is still narrower. Issuers with trailing annual sales of above 100 million and a price-to-sales ratio of above 40 have averaged a 45% drawdown over 3 years following the first-day close, measured since 1980. SpaceX has printed approximately 93 times trailing sales. Two cross-currents are worth flagging before that base rate is applied. Anthropic's reported 30 billion annualized revenue run rate now exceeds OpenAI's 20 billion plus, which complicates the conventional ranking by monetization. Anthropic is also reportedly renting compute capacity from xAI at a notional $15 billion per year, a supply chain dependency on a competitor's infrastructure that should be priced separately from product quality when asserting the three names against one another. And this brings us to the absorption question. The cleanest way to frame the allocator question is to ask where the 180 billion comes from. Three sources are available and each has distinct second-order consequences. Rotation from the incumbent AI longs is the most likely first source. The marginal AI overweight allocator is already at or near maximum. The new listings offer a way to refresh at fresh entry points. The effect is to compress multiples on existing AI names, the hyperscalers, the chip cohort, the application layer incumbents, even if the underlying fundamentals remain intact. Rotation from other equity sectors is the second source and the most macro-relevant. The natural funding sectors in such rotation have historically been the income-yielding, low-growth defensives, staples, utilities, telecoms. Now, against the current bond stress backdrop, those are precisely the sectors whose relative attractiveness depends on yield differential against duration that has already moved against them. The third source is cash and duration itself. A rotation out of short-dated treasuries or money market positions into an AIIPO equity is the most consequential because it removes capital from the funding side of the bond market at the same time that the long-duration sovereign supply is rising. Now, this is the absorption pressure point that is most worth monitoring through the Q3. For portfolio construction, three implications follow. Position sizing on the new listing should reflect the base rate distribution rather than the first-day demand signal. Sequencing also matters because entry stage through the lockup waterfall are likely to encounter better risk-reward than the concentrated participation at the listing window. And lastly, the structural distinction between SpaceX and the pure-play AI lab matters more than the IPO bonanza framing suggests. Let's wrap up this particular episode with sleeving the three names. SpaceX is not unpresent economics in AI play. The first quarter of 2026 showed a $1.9 billion operating loss at a group level, of which $2.5 billion was attributable to the AI segment, meaning Starlink and the launch business are subsidizing the AI bet and not the other way around. Starlink generated $11.4 billion in revenue in 2025 at a 63% EBITDA margin, which makes it a profitable telecom infrastructure business with an embedded AI option. The orbital AI thesis is the speculative leg and not the load-bearing one. Allocator should sleeve this position accordingly. SpaceX exposure is closer to the telecom infrastructure with long-dated optionality overlay than a pure AI lab. OpenAI and Anthropic are the pure-play exposures. Anthropic's product monetization has pulled ahead, but its compute supply is structurally dependent on competitors' infrastructure. OpenAI has the compute scale advantage but trails on revenue run rate. Neither is a clean trade. The historical reference point that matters most is Meta. Investors who bought on the first day are up 1,474%. Investors who waited 6 months are up 2,454%. The lockup waterfall is where the real entry opportunity has historically lived for mega IPOs, and the engineered distribution architecture of this cycle gives that waterfall more shape, not less. Patience is a structural position out here. That's all that we wanted to share with you in this particular episode of Capital Insights from the Fundamentals to Noise series. Stay tuned in for our next episode.